Well, this presentation will cover how to determine your percentage risk per trade. Now, the goal of the presentation is to help you understand why the determination of your percentage risk that you're taking per trade is important. It'll give you an idea of how professional traders determine their percentage risk per trade for their own trading or that of their clients. Now, we'll cover the information you need to know to calculate this variable, whether it's from a performance report, a system description, or a fund manager. And finally, we'll show you how it is calculated and give you some examples so that you can better understand it with regard to your own trading. All right, well, first we need to evaluate why determining your percentage risk per trade is important. It helps you minimize your risk, which is generally paramount importance to the professional trader. You see, professional traders look at minimizing risk first, while the novice trader looks at their rates of return. Further, it helps you reduce your emotional stress. Now, for anyone who's traded for some time, you'd probably agree that making trading decisions when you're emotionally charged is not a good idea. Now, I believe that your trade intelligence goes down as your emotions go up. It also allows you to trade through losses. You know, the market is anything but predictable. No one knows what will happen in the markets tomorrow. Explaining what's already happened is always much easier than predicting what will happen in the future. And finally, it allows you the time to make changes if necessary. See, professional traders always leave themselves options to make changes when their trading rules dictate that they do so. They generally have a clearly defined rules-based trading plan that tells them what to do and when, based solely on their objective data. All right, well, next we need to understand what rules the professional traders use. Generally, they keep their percentage risk per trade at less than 1% of their total trade capital. Now, for those with smaller accounts or seeking higher returns, you can allow up to no more than 2% of your total trade capital, provided you minimize your risk by other means described in future video tutorials. Now we'll take a look at what information you'll need to have to make this calculation. You know, this is one of the most simple calculations a trader needs to become familiar with, but one that few novice traders ever consider. There are only two pieces of data needed to make this calculation, and the first is your total trade capital. And the second is your maximum loss, which generally can be found by looking at a performance report, the trade data, or a system description. Now, if variable stops are utilized, you should use the largest loss to date. Well, let's take a look at the formula used to calculate the percentage risk per trade. Now, percentage risk per trade is equal to the maximum loss divided by the total trade capital times 100. So let's take a look at some examples. Let's say we have a stop loss of $300 and $5,000 worth of trade capital. Now we're going to calculate what our percentage risk per trade is. So let's bring up a calculator here and do that calculation. So $300 divided by 5,000 times 100 is 6% risk per trade. That is much too high. And if you were to trade with 6% of your capital at risk per trade, after a string of 5 to 10 losses, it might wipe out your account and you'd have to add more money or discontinue your trading. So let's make a quick change so that we calculate the total trade capital needed to reduce this to a 1.5% risk per trade. All right, so let me bring up the calculator again and let's make this calculation. Actually, we should probably look at the new formula, and we're just manipulating this data here to get total trade capital to equal the maximum stop loss, which we know, times 100 divided by your desired percentage risk per trade, which we also know. So let's go ahead and calculate that now. Your max stop loss is $300 in this case. Multiply that by 100 and then divide that by 1.5%. And you should realize that you need $20,000 per contract to trade this futures system to keep your percentage risk per trade at 1.5%. Now that's quite a bit more than most traders allow for, and that's why a lot of people kind of blow up their accounts. Well, let's take a look at a professional example and see what professional traders do if they actually follow these rules. So this is a portfolio performance report that shows a largest loss of $1,530. Now, this is across 8 different systems traded in the futures market. This client uses $25,000 per contract. So this 8 system portfolio would allow for $200,000 worth of capital. So let's take the maximum loss, which is $1,530, divided by 200,000, and then multiply that by 100, and you get 0.765% risk per trade. So they're well within that 1% limit. Now here, the calculation shows a 0.07%. Well, why is that? Well, if you were to look at the equity graph, when that max or when that max loss happened, it was probably when the equity had appreciated significantly. So you have to understand that these numbers here and how they're calculated may differ from your initial total trade capital. And a lot of people will trade for cash flow where they're pulling profits off the table every month, and that's fine too. But you should always use your initial trade capital to calculate your percentage risk per trade. And that's it. Hope that helps.